first of all, and second of all, thanks for letting me know the audio is good. Just making sure the stream looks good. So if there's anything that looks off, just please let me know. Let's run through this. They cut rates, as I mentioned, but just want to read some of the highlights that are kind of critical to understand the point of thinking and contention. Right now, we have a really interesting scenario happening globally, specifically as it comes to the bond market, which I'll get into detail with today. But let's just read some of these highlights. First highlight, most core inflation figures suggest inflation will stabilize at target. Labor costs gradually moderating. Wage tracker points to further easing in 2025. Staff wage growth to fall below 3% in 2026 and 2027. Risk to growth tilted to the downside. Inflation outlook more uncertain than usual. ECB's policy vote was almost unanimous, one dissenter, and everything points to inflation settling at 2%. I wouldn't exclude further upward revisions to growth. That's the first group of highlights. And then we'll give some thoughts on it. Second, just nearly concluded policy cycle. Obviously, they're working on getting their rate wherever their target rate is, but close to 2%. We are in good position based on the current rate path. We have not discussed a neutral rate. Like I just mentioned, wherever that is. I don't know where the neutral rate is. They don't know where their neutral rate is. They're basing it off of data. Oops. Neutral is predicted on absence shock. Facing significant uncertainty, had extensive discussion on impact of disruption to supply chain. I got to open this up, sorry. Getting to the end of the monetary policy cycle. We are near the end of the monetary policy cycle, but they cannot tell us yet where the neutral rate is. For those that don't know what the neutral rate is, that's just where they will sit. They'll cut, then they'll hit something. They'll hit a level that it just stays at. That's what we call the neutral rate. But they will declare we have reached the neutral rate. So just because a rate stays somewhere, like think about the Fed right now, a rate has stayed with the Fed for quite some time. Doesn't mean that we're currently at a neutral rate. We have to have a declaration of what that neutral rate will look like. Obviously, they're continuing to watch 3 different metrics. Every single monetary policy decision-making group will watch 3 different metrics. Metric number 1 always has to do with inflation. What does price look like? Are prices increasing? Are they decreasing? Are they stagnant? As you know, globally, the target for inflation is 2%. Number 2, they're going to look at the labor data, meaning work, jobs. So they're going to look at things like job openings, unemployment claims, things of that nature. And number 3, they're going to look at growth of the economy, which involves GDP and retail sales. No matter who you are, no matter what country you're in, you have a similar vision and a similar goal. Your goal is to maintain steady jobs while bringing inflation to 2%. And also, of course, having an economy that's still growing. In doing this transition back down to 2% inflation here from the ECB, you have many risks. Risks involve potential stagflation. Risks also involve potential inflation because you reduce rates too quickly. Donald Trump himself, just in the last 48 hours, has mentioned that the Federal Reserve here in the U.S. is just too slow. He's called him too slow Powell many times. And oftentimes, he refers to the ECB and what they have done in terms of rate cuts, the amount I'm talking, the amount of times they've cut their rate, and saying, look at what they've done, why can't we do this? And today we're going to get into detail in which the bond market is sort of the thing that you need to pay the most attention to. But that's what happened today, and that does impact today in a positive manner because the market expected this. It has been impacting I shouldn't say but some of you guys have been with me for a long time, so you know that we were in this trade. Euro, USD, That wasn't the one. Euro USD was this one. There it was. So on the 28th of April, we had called this out, this 1.1174 level. And obviously it's currently, what's the date? The 5th of June. We're almost at full target here. We have now moved stops, of course, to mitigate our risk. And the dollar weakening out is still the name of the game for me. I'll continue to say that across the board. It has nothing to do with the ECB. But the dollar continuing to weaken out will continue to be the name of the game. What I do expect over the course of the next couple of weeks is a little bit of difficulty as it pertains to the dollar with its current sort of weakening out cycle. So a lot of you guys are, for rightfully so, across, it's amazing, this educator panel that you have here at ZiNRai. I've been watching a lot of the sessions, and it's funny that a lot of us have the same bias on a lot of the same charts. One of them being just absolutely crushing it on gold. A lot of the educators are just smashing it on gold right now, trying to get long on gold. That's no different from me. I just haven't entered in a while. My last gold play was way back in May 14th, May 15th, right here. And I'll pull that up as well so you can see the timestamp date when we sent this out. That was May 8th, 3136.87. That was that level. You can see we came down to 3136.87 and then bounced. Everything I'm doing is, of course, not based off of the same models as all the other educators. A lot of the educators are using more liquidity models than anything, which is phenomenal. As you guys know, my models are based off of Fibonacci. And so anyway, long story short, when I look at this, let me draw this really quick. The current bullish cycle that you're experiencing out of gold, silver, euro dollar, all of this is really basing itself off of this dollar weakness. And you just ought to be a little bit cautious as you get closer to the bottom on the dollar as it pertains to that dollar weakness on the DXY, that highlighted yellow level. As we, of course, have had buyers here in April, we expect to get buyers again on the dollar at that level again, which can slow down sort of your roll a little bit. Secondly, though, you need to recognize it. What I mean by recognize it is also an opportunity. If it were to break lower, that were to signal, I'll have to even go up on like the weekly time frame. We break lower, which we've just broken the more major level, but we were to break lower this daily level, that can signal more downside on the dollar, which can help our chances of gold, silver, that sort of stuff as the dollar continues to weak out. Speaking of silver, silver is just a sneeze away from hitting our full target. This was silver at 28.44.529. By the way, I'm going to pause here. For those of you guys that are in that Telegram, can you put some ones in the chat that you're with me so far, that I'm not talking your ear off? Just kind of referring to some of these older setups that I'm still monitoring. Now, this one was pretty old. That wasn't even the setup. That wasn't it either. Where's my screenshot? Again, that bullish bias. Market came down. Disclaimer for you guys. I know you're probably looking at this silver and this gold and you're like, oh my gosh, what is this? Both of them rejected perfectly. I'll put this out there. I wish every trade worked out like this. This has just been, this last month for me has just been as smooth sailing as probably anybody could ask for. It's not always the case. There's plenty of times where, you got to really battle this zone a little bit because it's a fairly big zone. The way that I trade is I trade off of zones, which the good news is I know that a lot of you guys that are in this live session right now, you trade off of different smart money concepts, liquidity concepts, and different models of that nature that in doing so, the good news is your method could align inside of my zones, and then you got a double confluence, which could be nice for you. And so anyway, when I look at gold and silver, in particular silver, we just need a little nudge higher and we've hit full target. How did I base my target? Well, you might look at this and say, how are you basing your target? Is it based off of a level of structure? Is it based off of a Fibonacci level? What is it based off of? The answer is actually none of that. It's simply based off of risk to reward. 1 to 2 risk to reward every trade. That's just all I do. I keep it pretty simple. So what that means is the original setup looked like this. The original setup was based off of that green line at 28.44529. So that, I'm just going to draw the box over here if you guys can see it. I just don't want to mess up this. So that was the original setup in terms of the level that we were interested in to get long. Our risk is at the bottom of our box. Pretty self-explanatory with the colors. Our reward is not based off structure, not based off fib. It's based off where is the 1 to 2. The answer is right there. And so now you can see, and this goes for all of them. I'll show you everything that I've currently got rolling just to give you guys an idea of where I'm at. Then we'll talk about if we see anything that could be interesting. That's how everything is targeted. So when you look at silver, that's based off of 1 to 2. If you look at euro dollar, which hopefully we can get a move higher. Obviously, the cutting of rates right now is going to hinder us a little bit. But that's the target there. Gold, that's the target there. And again, it's not because I think it can stop there. It's just simply the 1 to 2. So that's our dollar grouping. Finally, we have dollar yen. Dollar yen was, let me see when I sent this one out. The 8th. So here it was 5/8. You can see the timestamp on the top. I think you can see the timestamp on the top. Excuse me, my fault. So anyway, this was at 148.367. Here we were, 148.367. Market came up, hit our level, rejected off of it. And again, as you guys can probably now guess, the target is simply where our 1 to 2 was. So if we were to redraw this position just for sake of learning today, we would roll our stops up to the top of the red box. And where's our target going to be? It's at our 1 to 2. I do that because here's the facts. Type in a yes in the chat box if you know who I am. You've traded with me many times before. Type in a no if you're brand new and you don't know who I am. No if you don't know who I am. I'm curious really quick. Yes if you know who I am, you get my lingo, you know what I do. No if you're new to me, which is totally fine. I actually love that because I want to meet new people. Anyway, type that in the chat box really quick. And those of you guys that are watching this that don't know where the chat box is, I'm just part of some of these Telegram groups or these trading groups while we're still free, where I'm able to read their chats. So I understand if you're watching this just alone with no Telegram, you don't know where this chat box is. That's okay too. You could just say it in your head, yes or no. The reason I ask is this, or the reason I say this is this. Anybody that's traded with me for a long period of time, I'm about to tell you something that's probably gonna not seem like it's gonna seem like a curveball. Anybody that's traded me a long period of time, you know that we've watched me trade and tracked the results for a long period of time, even via spreadsheets, live. My accuracy rating sits between 35 and 45% on any given week. So out of 10, or say 100 trades, 35, 40, 45, somewhere in there, it's going to fluctuate week to week, are going to win, and the rest are either A, going to hit break even, or B, are going to lose. So why do I say that? Why I say that is if I have a 1-to-2 risk-reward ratio, and I look at this versus my accuracy, we can look at all these sort of charts. What that means is, in a risk-to-reward ratio scenario, I need to win 35% of the time in order to roll into profitability. That's a good thing for me, because anything above 35%, which is 40, 45%, somewhere in there, that's all gravy. I'm only sharing this with any of you guys because we live in a world now of Instagrams, of YouTubes. I've seen Jordan rant about this. It's a lot of like, let me show you how to be 90% accurate words. Let me show you how to win all your trades, which, let's face it, their risk to reward is probably negative. They're probably risking more than the reward is. And the reason they're doing that is not because they set it up this way, but they do something that's even worse. Let's say this is price. They enter the trade, they're in profit, they get excited, they exit right there at that line. And then they say to themselves, the worst line you could ever tell yourself in the history of trading. You can't go broke taking profit. That's such a lie. So they exit right there fully. Well, what was their risk to reward? Actually, it was 0.72. Well, at a 0.72 risk to reward, I must win north of 50% of my trades. Much more, actually. 60% of my trades in order to even pull a break even. To be profitable, I got to be above 65, 70. Well, now what you've done is you've numerically trapped yourself. I got to win a bunch of my trades in order to make money. A couple of the interesting things with trading is, number one, you don't have to be right all the time to make money. You don't have to know where the market's going to go to make money. You just simply have to realize the market is a neutral being. It's an emotional being because it's comprised of institutions and retail and everybody. It's emotional. But we don't have to know what's going to happen next in order to make money. We just have to have what's called a defined edge, which means a place where the probability, like right here, the probability of the market rejecting at that level is greater than it not. It's called an edge. And as long as I have an edge in the market and I consistently take the same edge with the same risk-reward principles, I'm going to be able to systematically, statistically trap myself into the best situation possible in order to make money in these markets. The amazing thing about trading is that you can trap yourself into that. But the hardest thing about trading is that you have to have the patience in order to do so. I think the hardest part of trading, as I'm kind of sharing these positions that I'm currently rolling into, is staying in. Some of you guys might agree with that. The hardest part is not the entry, not the execution, not setting your parameters of where your risk is going to be. The hardest part is in a trade, in profit, staying in. I've seen tons of people be able to ride a trade to stop loss. They're okay with riding negative because they have this hope that somehow it'll turn positive. But the moment it turns positive, how many of you guys have dealt with this or seen this before? Put a 1 in the chat. The moment it turns positive, what happens? Oh my gosh, you can't go broke taking profit. I got to take it out. It's really hard. So euro dollar, tough to stay in. Silver, tough to stay in. Gold, tough to stay in. Dollar yen, tough to stay in. And last but not least, getting out of the dollar is euro CAD, which this one, talk about tough to stay in. Oh my gosh, this trade, for lack of better words, sucks. Only reason being is just that it's been consolidated basically ever since the first reaction. Let me find when I sent this out. Sent this thing out on 5/8. So 5/8, about a month ago, sent this thing out at 1.55257. 1.55257. hit our entry price, rejected up, moved our stops to break even, as you can see. And the market now has just fiddled back and forth. Really, it's consolidating almost in a manner of here. And so now you're waiting. And the worst case scenario is that you have to wait until, what is that going to be, June 16th-ish to make a final decision. We were working our way up today, and then, of course, ECB cut rates. ECB cutting rates, which means we're getting closer and closer and closer to that neutral rate. Lower rates generally bring a little bit of weakness. So that's a recap of all of those positions. The last large position that almost everybody knows, just if they follow me publicly, because I shared this trade with everybody publicly on YouTube back in November of 2022, was, of course, Bitcoin. So talk about a tough one to stay in. As you guys know, I have not changed that position. That position is not that one. Down here. November of 2022 at 16.5. And we're sitting at 104.866. Waiting for the next leg higher. We'll talk about that with Mike on our Wednesday huddles, if you guys see that on the schedule in the crypto section. Let me pull this up real quick. Under the stock and crypto section, Mike and I have a midweek huddle. That is the session that I will host with him at 5 p.m. Eastern every Wednesday. Set your calendar for that. Mike and I will have that. And we will be discussing things of that nature, so I'm not going to discuss that today. Okay, so that gives us about a 30-minute kind of recap of where my thoughts are with the market in general there. Now what I'd love to do is kind of take a step back here to earlier this week and just kind of roll through a couple of the different highlights from the week. The first of all being the some of the remarks from Jerome Powell. And it was a address, the Princeton class, that's where it is. Yeah, that's right. Princeton class of 2025. Not a lot of massive, fundamental pressure here. But he kind of had some rhetoric here about guarding themselves and basically protecting who they are, being who they are, guarding who they are. And I think that a lot of that, and the media picked up on this, a lot of that came from the thought process of what Trump has been saying, calling him a major loser. Now, speaking of Trump, a couple things that are just, this is live, so I'm reading this as we speak. This literally is just coming out as we speak, and it's still developing just in the last few hours. President Trump said that trade officials from U.S. and China will be meeting soon. The announcement came. The call will be initiated by Trump. I'm not going to read through that. The very good call, according to Trump, came about a 90-minute call focused almost entirely on trade. It resulted in a very positive conclusion for both countries. Let's see. Very positive conclusion for most countries. There should no longer be any questions respecting the complexity of rare earth products. Let's see. Really nothing else. Now, why I look at that is what's interesting right now. Let's bop into something. Let's go to the NASDAQ. The NASDAQ, by the way, you can look at another variation of that. This one's already hit target, so that's why I didn't talk about it. But you can look at an old variation of NAS. When was that one sent? This is way long ago. 17,226 in the middle of the dip of the tariff talks. That was March 31st, 17,226. great opportunity, hit full target. Anyway, as you guys can see, we're working our way towards all-time highs. The trade talks matter. Now, I know a lot of you guys are new to my sessions. I've kind of made a joke. I'm eventually going to get a hat that says on my hat, Perma Bull. You'll never hear me talking about shorting anything in terms of the NASDAQ or the S&P or the Dow. It's just, bears sound smart, bulls make money. That's my mantra. And so I'm always looking for opportunities to get long. I'm certainly not looking for opportunities to get short. These highs don't scare me, as many of you guys know. I'm willing to bet on new highs. In particular for this one, the next level that's important is $22,854.10. That's that 1618 extension. Anyway, looking at this, yes or no in the chat box, is the market enthused by trade talks? Are they happy by trade talks? Yes or no? In the chat box. Does the market seem happy from trade talks? Look at the NAS. Look at the Dow. Look at the S&P. All three of which on the day are positive. The market is happy with trade talks. What's also interesting is gold is down today. Why is gold down today? Well, gold is thriving off of a world of uncertainty. Uncertainty around tariffs, uncertainty around the economy, uncertainty just around the globe itself. We have geopolitical tensions. We have the list goes on, but we have Russia and Ukraine. We have Iran and Israel. the list goes on. We have the U.S. and China, technically speaking. We sort of have Canada and the U.S. We've got all this sort of stuff moving and grooving right now as we speak. And as we look through it, we realize that in the moment of certainty, equity markets are dwelling as we speak. And in a moment of certainty, in this case, gold starts to say, a little bit too much certainty. Let's pull back a little bit. Again, these sort of opportunities are what I would look for future opportunities to buy the dips on silver and on gold. So I would be bullish. If you're looking at gold right now, if you're looking at its price action lower time frame, I would be looking for dips. I wouldn't be looking to sell these rallies. I'd be looking for opportunities for dips to get long again. Now, let me pull some stuff up. Let's see what we can find today. See if there's any new opportunities. By the way, any charts you guys have perspectives on you want to share with me in the chat box, feel free to. I'm just kind of looking around and seeing what could we potentially look at. Hold that thought. Aussie yen is interesting. I think I've got something for you on Aussie yen. I'm just not going to look at it yet because I want to look through everything. Yeah, I think Aussie yen. All right, so let's look at Aussie yen. In terms of new setups, Aussie yen's got a couple points that you got to watch for. First of all, in terms of this yen strength, I'm a big bull right now on the yen. So a lot of my price action behavior will treat it that way. Fundamentally, I'm bullish on the yen. And so I expect things like Aussie yen, dollar yen, etc. to go down over time. That's the same reason why we've got that dollar yen play active as we speak. I expect continued yen strength. And again, the last thing I'll talk about today on today's session is the bond market itself, which I think is the most important things to talk about anyway, as we speak. Anyway, that's why I like this short. And I like it short because of the current pressure that Japan has the capability, but also, of course, they're in a little bit of a different side of things. They're in a different side of things as it comes to rates. The world is cutting rates. Japan has been increasing rates. Puts pressure on their currency value to go up, in short. Now, as I look through this, I don't want to invalidate this level. This high, us going higher through that level pushes my bias a little bit. If we're below that level, I like to trade it short. So the question becomes how to trade it short. Well, we have to measure and see if we break that level or not in a traditional three-leg sense. The answer is no. And so as you look at this, I'm going to start to watch for Aussie yen short over the next week at 94.252. Again, that's 94.252. That area is the next area of contention for me in terms of bearishness on Aussie yen. We're just above the 61.8 at that level as well. Not perfect confluence there, but decent confluence there. So I'll hold that on screen there for a minute. Put a 1 in the chat once you have this saved. I'm just going to hold it here for a minute and let you guys take a picture of it, whatever you got to do. And put a 1 in the chat when you got it saved. That's, again, Aussie yen we'll take a look at over the course of next few sessions and see if that emerges as something to pay close attention to. Okay. Now, the last thing I want to talk about today is the big stuff. The bond market. The reason to be scared or not. Long story short, the 10-year bond continues to wedge out. No matter of the little anomalies breaking above or below, we've continued to consolidate out. And I've talked about this. That's why there's random scribble marks. I've talked about this before. But you kind of are forced to come to the end of the road by late summer. It needs to make a decision at some point. The reason this is nerve-wracking for the world is this yield over the last few weeks, we've been working up, and then finally now we're finally working back down. As you guys know, in order for the yield to go up, we have to have less buyers of the bond. In order for the yield to go down, it means people are buying the bond again. I'm simplifying it because it's not necessarily just people, as you guys know. It's institutions. It's literally countries. Japan is the largest holder of U.S. Treasuries. China is the third largest holder. The UK is the second largest holder as we speak. The UK just overtook China in the last week, by the way, as now the second largest holder. China is offloading U.S. Treasuries fast, which has to do with their trust, but they're also the trust in the credit rating of the U.S., but also their what they want to be as independent from the U.S. as possible. Why is this dangerous? Well, it's dangerous because the Federal Reserve and Jerome Powell, they're deciding when and where to cut rates, and they haven't done that again since their last cut early this year. And right now, as we speak, from an odds perspective, let's take a peek. Aggregated data will show you that as we speak right now, we have a 97% chance of not cutting rates in June, 68% chance of not cutting rates in July, and a 97% chance that we do cut rates in September. We've continued to kick the can down the road. Rate cuts simply will not happen until September, according to the markets. This is the Fed funds futures. But why that's secondarily important is, as much as people believe, oh, when the Fed cuts rates, interest rates drop, that's not the case. The bond has to trade with it. And in order for the rate to drop, people have to be buying bonds. We have to see pressure in the US 10. So as you can see, lately we've had pressure in the US 10, buying bonds, which means the yield has gone down. Well, why would someone buy a bond? Why does anybody buy a bond? Well, they're trying to shelter themselves. It's a mitigation tactic. Equities carry inherent risk. Even commodities carry some inherent risk. Cryptos carry inherent risk. Real estate carries inherent risk. But when you roll into a bond, you're saying, okay, this bond is backed by the full faith of the U.S. government. They will simply print themselves out of this, if need be. They will print themselves to pay us back. Okay, true. But people are buying bonds when they're extremely, extremely terrified of the economy. And if the Fed cuts rates just quietly in the next few months and the economy is still humming along, people might look at that and say, I'll just keep it in cash. And if they're not buying bonds, the yield's not falling, which is what the Fed wants. When the Fed starts to cut rates, they expect the yield to fall. It didn't do it last time. The longer we stay on this, it's not a sprint, it's a treadmill. When rates are high, it's like you being on a treadmill. And so the longer you stay on the treadmill, aka the longer the U.S. maintains high rates, the harder it gets. If you're on a treadmill for 5 minutes, it's way easier than 5 hours. Even if the speed has been cut by a half a mile an hour or a kilometer an hour. If it's been cut, the longer you're on there, even if you're going at a slower pace, you start to fatigue. The economy is the same way. As much as the Fed says, we're waiting. We want to see inflation fall. We want to see the effects of tariffs. We want to see that we can reach this 2% inflationary goal. The longer it stays like that, the more deterioration it has on the U.S. economy, which has a higher inherent risk that the economy then cracks. Some would say it's already cracking. But even if that's the case, as a person like myself, as a perma-bull, we simply wait for opportunities in that. Right now, everything's kind of happy-go-lucky. As long as you're able to click a button and get long on basically anything, why I say anything is gold, silver, Bitcoin, or equities, you're making money in these markets over the last 30, 60 days. We've had just one hiccup this entire year. That was, of course, March and April. So that's my overall thoughts of the markets right now. Obviously, I'm just trying to get an overall scope, not as many setups right now for the future. Monday, Tuesday, Wednesday, and Thursday is the Chart Lab with me. Again, really excited to be sharing some time with you guys. I can't say enough about this. This is insane. This is insane. What's about to, and this isn't even everybody yet on this. There's a few more coming. If you're, put a 1 in the chat. Put a 1 in the chat if you're excited about this panel here. It's not even it's not finalized, but what I mean by that is there are a few more coming. But this is like equivalent of a professional sports team that built like that mega team. I'm just so excited about this because like I learned so much from these people. And I can't comprehend a world where the stars aligned at the same time and this group of people, and I'm not trying to exclude any other of the lists, obviously, all was able to make it happen at the same time. The stars, everything had to line up perfect. I'm just so excited about that. So let me ask you guys, what questions do you have for me today? I'm going to answer a couple in the one Telegram that I am in. For the rest of you guys that are watching without a chat box, keep in mind the chat box is being developed as we speak. So just, keep in mind all of that. Just have a little bit of patience for a couple of weeks. That's why literally no credit cards required right now. And you'll be good. Let's see. Was it 5 p.m. the live? 5 p.m. Eastern is the live. Right here. It's called Midweek Huddle. Doesn't mention my name, but that's the one that I'll be on. And so I will be with Mike on Wednesdays on his channel, Midweek Huddle, talking everything stocks, options, and crypto. So that answers Josh's question. Yes, we will be doing options. I think in many regards, if you guys have not traded options, stock options in particular, it's like, that's one of my favorite ways to make money. It just is. It's just like, if you've never done it, you just got to join one of those sessions when we do it. What other questions you guys got? Josh, Claire, Leroy, Dwayne. Who else? Marcus, anybody that's in here, thank you for coming. I've had some technical things with the tech side this week, so I haven't been able to go live, but I was excited to at least do one session this week with you guys. Get after it next week, right? What other questions you got for me? By the way, up after me is Iffy at 9 or aka noon. And so you'll be able to pop onto his session next. After him is Jordan. It's crazy. This is crazy. This is like the Bulls. This is like the Warriors. This is like the Bulls. This is crazy. I can't believe this. Unbelievable. All right. I'll wrap it there. No need to talk your ear off. Everybody can get prepped and ready for Iffy's session. And, just again, really excited to have a chance to work with all of you, get to know all of you. We'll spend the next several years together and get to know each other on a deeper level and have some fun time.